Hello, welcome back to this course on financial fraud, how to detect and prevent, and how to understand the understand the financial statements fraud, how to detect them. Now, first of all, let's try to talk about the first method of doing the financial fraud. In the previous slide, we discussed there are five main principles of doing the fraud. One is fictitious revenue, timing difference, asset valuations, current liability, concealed liabilities and expenses, and also the improper disclosures. Now, let us understand the first one, which is called fictitious revenues. So in the fictitious revenues, what happens is you company is recording the goods and services that did not occur in the real world, or they are recording the sales to the fake numbers, fake customers. Maybe they or maybe there are legitimate customers, but the goods the actual amount of the sales is higher, is inflated, or there are sales with the conditions that there are certain conditions that need to be completed first, but before you complete those conditions, you are recognizing the sales as a income already, or there are pressure to boost the revenue, so you are doing illegal things to boost up the revenues. Now, in order to recognize the sale, there has to be certain conditions which you have to fulfill. The sales is recognizable only when it is realized or realizable and earned. Now, the following conditions has to be met. First is there is a persuasive evidence that the agreement is there, means there is a real customer, there is a real agreement, and the agreement is clear what needs to be produced, what will be the compensation, and the compensation is measurable. So you cannot just say, hey, I'm giving you the goods and services, you give me your services which are not recognizable, which are not measurable in the real market terms, because there's no market price for them. So how will you recognize, how will you do the measurement of the revenue? Very difficult, right? So you have to have certain measurement of the compensation that you are going to receive from the customer. It can be money or it can be in kind, maybe like a barter agreement with the advertisement companies to do the sales. And the delivery has to be occurred, or services has to be produced in order to get the recognized sale. So you have to first deliver the goods and or have produced the services already, and the title of the goods and the responsibility of goods has already been transferred to the consumer, and the seller's price is fixed and is determinable, and the collectibility is reasonably insured. Now, that is the very important condition, that you have to demonstrate that the amount which is being sold is will be collectible in the future. Is not that, okay, you know that the person is already bankrupt, you have sold them something at a price, and you know that now you know that the amount is not recognizable and not recoverable anymore, but you have recognized that as an income in your books of account. That is not correct. You cannot do that, right? So the way to do the fictitious sale is, maybe you have recognized a fictitious invoice, or maybe you have prepared the invoice but you have not sent it to the supplier or to the customer, or there is a the goods has not been delivered, there is a fake purchase order coming from the purchaser. You have raised the invoice, but you have not delivered the goods, or you have not sent the invoice to your customer, but you have recognized the sale in your books, and thus the account receivable has increased. Now, how will you know that, right? So now we have understood that, okay, these are the way of different ways of fictitious booking the fictitious revenue. So how do we uh, uh, to protect them? There are certain red flags. The red flags to understand the fictitious revenue are: there is a rapid growth or unusual profitability, especially when you compare with that of other companies and within the same industries. So normally auditors will see the common size financial statements, the GOP percentage, the gross profit percentage, and compare with the industry standards. There may be different business models which may say, hey, your operating profit can be different. Fine, but you have to justify that by showing the real reason why the profitability is higher or lower compared to the industry peers. There is a negative cash flow continuously occurring from the operations, because as you know, if we record the sales, you have to record the debit somewhere. You have to record the debit somewhere. So either in cash or will be in the supply in the debtors. When you record the sales, let's look at it from an example in the Excel file so that it's clearer. So in this Excel file, there is a dummy profit and loss statement that we have prepared. There is a equity, then there is assets, some inventory, some cash, some account receivable, and then there is a sale. Another net profitability is there. Now let us say we have a net profit percentage now of about 10%. Right. So first thing what will happen when you are recognizing a fake sale, let's say you have recognized a $5,000 sales which is fake, not real. It's not real. So what you will do is you will change this to $25,000. The first thing which will happen is that your profitability will jump from 10% to 28%. Means that when you are comparing the financial profitability from one period to another period, there will be a jump in the profitability. So that is the first red flag. The second red flag, now you will see that the balance sheet has gone out of order because you have recognized the sale, but you don't have a real customer. So what you will do, you will put that money into your account receivable, because you cannot do the cash will be matched with the bank accounts, right? So you, in order to hide the difference, you need to increase your customer sales account receivable. So your account receivable will increase to 7,000. However, your cash remains the same. There is no difference, right? So means that when you are calculating the cash flow from your operations, right? And if you have taken the class on how to prepare the cash flow, you will see that the account, when we are preparing the cash flow from operations, what we do is we take the net profit, add or reduce the increase in the working capital, right? So changes in the working capital is adjusted to the operating profit. Increase in the current assets is reduced from the profit. So here, since the account receivable has increased, what will happen is when we prepare the cash flow, we will reduce the incremental part. So even though the net profit here is 7,000, the incremental account receivable was 5,000. So you will have to reduce the 5,000 from the profit. So your cash from operations will again be only 2,000. So this is how you can capture the fictitious sales, right? So let's make it back so that our formula is not same. So the another method, another red flag for the understanding the thing is that there is a significant transaction with the related parties. Now when you are doing the fake sales, you always do not want to put up in the account receivable. Why? The reason why, because normally auditors will send the AR to confirm the balances. So there is normally a year-end adjustment, year-end confirmation that the auditors will be sending to the parties and asking them to confirm the statement. When you are saying, when the auditor is saying that, hey, you owe us 7,000, the other party will say, no, I owe only 2,000. There is a huge difference. The auditors will try to investigate. But when you are not recording it as an account receivable, say, okay, intercompany account, that is again another difference. So let's now book the transaction again. So now you can increase it to 25,000. So the first red flag is the profitability. The second red flag, which is gonna, instead of account receivable, because yeah, you can say that my account receivable, I'm gonna get it confirmed from the auditors. The another way to hide this is put into the intercompany accounts. So now you are able to adjusted from the intercompany accounts. Or another way is sometimes you have advances, right, from in the current liabilities. So you can always go and adjust the current liabilities from the and put them into adjust it from the current liabilities. You can reduce it again. Normally auditors are not sending the advance for the balance confirmation. Usually they will send the account receivable for balance. So the auditors need to send all the third party balances for confirmation so that they can understand the balances are real or not real, right? So that is the another way to hide and detect the company. So whenever the as an auditor you see there is an intercompany there is a within the with there is an intercompany transaction or transaction with the associates, you can always judge what has been last year, what is this year, are they real or not, because intercompany accounts are easy to collect, right? Then there are other insignificant growth in the account receivable. So if you are putting that in the account receivable, so you can say, okay, instead of this I can change it to 7,000, right? So now what will happen is you will have to calculate the account receivable days. How do we calculate the account receivable days? If you have taken my financial ratio classes, so what you have the method to calculate the account receivable is to calculate an average sale first, average sales, which is 25,000 divided by 365, whatever it is, that's we will calculate it both, and then dividing the sales divide by the average. So here average receivable day is 102,000, right? And what would happen if there was real transaction? So this is 102. Let's write it down 102 so that the formula does not get affected. And we put back the original sale 20,000 in 2,000. Now you will see the account receivable days is only 37 compared to the fictitious sale where it was 102 days. So account receivable number of account receivable days, outstanding days have also increased, right? From 102 to 30, sorry, from 37 to 102. So there is one more way to catch the red flag from the financial ratio analysis point of view. Then you will have another surge in the sales within the orders, within the other entities, or maybe some one particular entity, because there is one sometimes you, in order to have less complication for the financial accountant, you identify only one company as fictitious company, so their particular account receivable are continue to grow without any collection because there is collection, right? So what will happen is their account will continue to grow over a period of time when the other are just on normal paying and billing. So when you are looking at the details of account receivable stuff, you would need to understand or you look at the differences so that you can actually understand if there is any particular entity which has a high balances. So now you learn now you have learned the fictitious sales, how to detect it. So there are three main methods of fictitious sales. One is recognizing the fake sales. Second is recognizing the sales which is not supposed to be because of certain conditions to be proved first. And then there is always a pressure to get more money. So there is another way. One more method is you take a loan, right? Give it to a supplier, ask them to book a sale, right? And then what you will do is there is a proper accounting, right? So you take on a personal loan which doesn't have to go to the balance sheet. You pay that money to your customer, ask them to pay the money back to the company and recognize the sale. Now what will happen with this is you can take the money and return to your bank. So bank is squared off, right? Now the since you have recognized the sale and you have a cash generating into your company, right? What will happen? The there is no movement of goods because you don't want to pay the goods for free, right? You wanna money, You want you just want the sales. So what will happen, the goods are extra, right? Or if you're not reducing the inventory, the profitability will jump up, but there is no other impact on the account receivable, there is no impact on cash, so there is nothing else except that the profitability will improve.